Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. U.S. President Donald Trump gives Israel and Iran a 2-week deadline to find a diplomatic way out of the war. Oil prices may jump by up to 4 pesos per liter as the Middle East conflict threatens global supply. And the Finance Department raises red flags over Trump's proposal to tax remittances sent by foreign workers. We begin with the latest on the escalating Middle East conflict. U.S. President Donald Trump is giving Israel and Iran 2 weeks to find a diplomatic way out before deciding whether to intervene militarily. In an interview on BNC's Agenda, Israeli ambassador to the Philippines, Elon Fluss, said Israel will not engage in diplomacy until its military objectives in Iran are met. Meanwhile, an Iran-backed Shiite militia in Iraq is threatening to strike U.S. bases in the region if Washington gets involved. On Thursday, an Iranian missile struck Israel's Soroka hospital, severely damaging the building and injuring 71 people, according to Israel's health ministry. Let's take a look at how global financial markets moved overnight. U.S. markets were closed for Juneteenth, a federal holiday marking the end of slavery, though President Donald Trump has yet to comment publicly on the occasion. In Europe, markets were on edge as the escalating conflict between Israel and Iran continues to rattle investor sentiment. Oil prices have been swinging wildly as fears flare over a potential disruption in global supply. Iran, a key oil producer, sits along the Strait of Hormuz, a strategic choke point that moves a fifth of the world's oil. European markets fell across the board. The FTSE 100 lower by 0.6%, Germany's DAX lower by 1.1%, and France's CAC 40 lower by 1.3%. Another fuel price hike is on the horizon, and this time it's big. Diesel could go up by more than 40 pesos per liter next week, with gasoline also set to rise, adding new pressure on transport costs, inflation, and consumer spending. The spike comes as geopolitical tensions in the Middle East escalate, with the Israel-Iran conflict sending global oil markets into turbulence. Jetty Petroleum President Leo Bellas says diesel prices could rise by over 4 pesos per liter, while gasoline may increase by nearly 3 pesos. Bellas notes that global trading has been extremely volatile, with crude oil prices still elevated amid fears of broader disruptions in supply. Now, a new U.S. tax plan could hit one of the Philippine economy's biggest lifelines, remittances. Finance Secretary Ralph Recto warns that President Donald Trump's proposal to tax money sent home by foreign workers may push Filipinos to turn to informal channels, undermining transparency and stability. Recto says if the tax measure moves forward, it could disrupt a flow of cash that helps fuel consumer spending and support millions of Filipino families. The bill, passed by the U.S. House of Representatives in May, includes a 3.5% excise tax on remittances sent abroad by foreign workers in the United States. Cash remittances to the Philippines rose 3% to $34.49 billion in 2024, with the United States accounting for over 40% of those total inflows. The World Bank says the Philippine economy remains strong, but growth is starting to slow. Sujin Kim has the details.
The Philippines has recorded robust but decelerating growth.
The World Bank noted the Philippine economy is losing steam amid deepening global trade uncertainty and intensifying geopolitical tensions. In its June 2025 Philippine Economic Update, the World Bank projected growth below the government's 6% target.
We have potentially higher or more persistent policy uncertainty, particularly around trade, that could result in even greater global growth deceleration than expected.
World Bank senior country economist Jafar Al-Rikabi pointed to headwinds from weak exports and sluggish industrial performance.
On the supply side, we see a deceleration in services, and given the export story, we see a deceleration in industry. Manufacturing has, of course, been affected by the global
On the fiscal side, the deficit widened to 7.3% of GDP in the first quarter. The World Bank expects the government to stay on track with spending plans and gradually narrow the deficit.
So that's our expectation, is that the government is committed to implementing its budget and its medium-term fiscal framework. And over the medium term, as I mentioned, the key is to gradually narrow the deficit to rebuild fiscal space.
The World Bank also warned of risks from tariff hikes, pointing to U.S. President Trump's 90-day pause on tariff increases as a crucial factor weighing on Philippine exports and investments. His recommendation:
the optimal response for the Philippines and for other countries is actually to double down on domestic reforms, reducing investment costs at home. So this is an opportunity for the Philippines to focus on doubling down on domestic reforms.
The World Bank urged the Philippines to continue pursuing regional trade deals to soften the blow from global trade risks. Soojin Kim, Bilyonaryo News Channel.
The World Bank is urging the Philippines to modernize its tax system, pairing reforms with smarter compliance to make taxes easier to pay and harder to dodge. The goal, to boost revenue without adding pressure on Filipinos. The country's fiscal deficit widened to 7.3% in early 2025. The World Bank says streamlining tax collection and covering digital platforms could strengthen government finances while easing the burden on ordinary taxpayers. It's also pushing for policies to empower small and medium enterprises, which drive most jobs and economic activity. Better access to financing, testing, and export markets could help SMEs scale up and compete globally. The cost of borrowing just dropped, but will it be enough to jumpstart a cooling economy? The Bangko Sentral cuts rates as inflation eases and global uncertainty grows. Soojin Kim returns with the story.
The Bangko Sentral ng Pilipinas delivered another interest rate cut, trimming its benchmark rate by 25 basis points to 5.25% in a bid to shore up growth. This marks the fifth cut this year, as the central bank responds to easing inflation and heightened risks from Middle East tensions and a slowing global economy. Likewise adjusted the overnight deposit and lending rates, now at 4.75 and 5.75% respectively. The BSP says the move is backed by a sharply lower inflation outlook. The 2025 average inflation forecast has been revised down to 1.6% from 2.4%.
We now recognize the slowdown in food inflation, something that we have been observing for the past 4 or 5 months of the year, and we think that it will continue to spill over.
Inflation estimates for 2026 and 2027 were raised slightly amid risks. The BSP warns of persistent pressures from higher oil prices, power rate adjustments, and rice tariff hikes. Moreover, despite the peso's continued weakness, Governor Eli Remolona ruled out any large-scale currency intervention for now.
We won't have enough reserves to do that. At some point, we would have to intervene more seriously if the depreciation continues.
In terms of the peso-dollar rate, we have incorporated the latest developments in the international oil markets. The Monetary Board is very vigilant, and they have identified the episodes or possible episodes of a further rise in oil prices as something that could add inflationary pressures moving forward. So we are looking at the developments in the Middle East as well as their impact on the inflation outlook.
The BSP signals another rate cut or even two could be on the table before the year ends, depending on how the data shapes up.
If things remain on track, then we'll probably cut once more. But depending on the data, we may cut twice more. Depending on the data, we may not cut at all. But for now, if things remain on track, as I said, isa pang 25 basis points.
With 3 policy meetings left in 2025, the central bank is expected to wrap up its easing cycle within the year. Soojin Kim, Bilyonaryo News Channel.
President Ferdinand Marcos Jr. accepts the courtesy resignations of 3 more executive officials, part of his ongoing push to reform the cabinet. Palace Press Officer Claire Castro confirms that Marcos has removed Presidential Legislative Liaison Office Secretary Mark Mendoza, Presidential Advisor on Military and Police Affairs Roman Feliz, and PNOC Renewables Director John Arenas. But he is retaining the leadership of 6 key GOCCs, including GSIS President Arnulfo Veloso, Land Bank President Lynette Ortiz, and PCSO General Manager Melquiades Robles. This latest shakeup comes amid growing questions about loyalty, performance, and the administration's direction ahead of 2028. In other news, travel is turning into traction, with tourism playing a bigger role in our economic story. The sector contributed 8.9% to GDP last year, the highest in 5 years, according to new data from the Philippine Statistics Authority. Tourism generated over 2.35 trillion pesos in value, powered by strong domestic spending and a rebound in jobs, now accounting for nearly 14% of the workforce. But the recovery still has room to run. International arrivals continue to fall short of targets, even as local travel picks up. Economists point to lower inflation and improved consumer confidence as drivers of domestic tourism. The focus now, keeping tourism money circulating locally and turning travel into broader economic growth. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Welcome back. Let's check on how Asian markets are doing this Friday morning. The Nikkei 225 is flat with a downward bias, lower by less than 0.1%. Hong Kong's Hang Seng Index is trading in the green, higher by 0.6%. Shanghai Composite flat with an upward bias, up by just 0.1%. And Singapore Straits Times Index with a slight upward bias as well, up by just 0.1%. Here at home, Philippine shares closed higher on Thursday as investors positioned ahead of the BSP's rate cut, betting on more easing amid soft inflation and peso stability. The PSE index rose 0.3% to 63.57, lifted by expectations of a pro-growth monetary stance. Market sentiment was also boosted by the U.S. Fed's decision to hold rates steady, easing pressure on emerging market currencies like the peso. The BSP delivered as expected. Now, with inflation at just 1.3% and the peso near 57, analysts expect at least one more cut this year. Monetary conditions are now firmly tilted towards growth, supporting credit, consumption, and real estate. But the risks remain, from volatile oil prices to escalating trade tensions. Now, right now, here at home as of 10:21 this morning, the main gauge, not much movement. It's down by 0.3% on thin volume and value. The broader all shares index is down by 0.2%. As for the sub-indices, the financials, industrial, property, and services sectors are pulling the market lower, whereas the holding firms and mining and oil counters are, trying to fight those losses. Total volume is thin at 101 million shares, valued at just a little 600 million pesos. Market breadth is negative, with 64 decliners, 58 advancers, and 42 stocks unchanged. Now, at the currency market, the peso opened stronger at 57.20 to the dollar, slipping from Wednesday's close of 57.45. Now, still on the peso, it just hit its weakest level in nearly 3 months, closing at 57.45 against the greenback yesterday as geopolitical risks continue to rattle markets. Now, that's the lowest since March 26, when it touched 57.69, with analysts pointing to heightened tensions in the Middle East, particularly between Israel and Iran, as a major driver of volatility. Economist Victor Abola of the University of the Asia and Pacific says the peso could stay under pressure over the short term as investors flee to the safety of the U.S. dollar. He notes that the peso had strengthened earlier this year, but the greenback has since rebounded on global uncertainty. While Abola doesn't expect a sharp inflation spike, he does warn that a weaker peso could erode export earnings and further dampen momentum in manufacturing at a time when the economy is already losing steam. Now, a showdown may be brewing between President Bongbong Marcos and his sister, Senator Amy, over a bill that could redefine who gets to control internet access in the Philippines. The challenge, breaking monopolies while keeping rules tight enough to protect consumers. Senator Amy Marcos is pushing to dismantle what she calls telecom monopolies, arguing that the internet reform bill will bring faster, more affordable service, especially in far-flung areas. But various groups have raised red flags, warning that without strong safeguards, the bill could lead to abuse, unfair advantage, or unchecked operators in our markets. The Konektadong Pinoy bill could be a game changer for internet access in the Philippines. It aims to open up the market, speed up infrastructure, and lower costs, promising cheaper, faster, and more reliable internet, especially for rural communities long left behind. But it's also facing tough questions about security, regulation, and whether it really levels the playing field for all providers. To break this down, we're joined by Joel Dabao, the CEO of KCAT and the former president of the Philippine Cable and Telecommunication Association. He spent decades in the industry and offers a frontline view of how this bill could transform the country's digital future. Hi, Joel.
Hi, Maiki. Good morning, and thanks for having me.
Yeah, good to have you. Very interesting topic. We want to connect the entire Philippines. So let's talk about that Konektadong Pinoy bill. Based on the latest 2022 data, Philippine internet is among the most expensive in Southeast Asia. 2 years later, this 2025, where do you think we stand when it comes to speed, access, and affordability?
I mean, it's certainly better than where we were 3 years ago, but it's not as far as it should be. There are many things holding us back, such as the regulatory framework, and even the business environment, I think, for the smaller players is a lot difficult. That's why we really need this bill to pass so that the smaller players can come up and compete equally with even the bigger players to reach the far-flung areas where smaller players like myself are situated.
When it comes to speed, access, and affordability, where are we lagging behind the most?
Within the region, Singapore is by far the leader, and Singapore also happens to have the most lax barriers to entry. I went on the internet the other day just to verify, and really, to get a license to be an internet service provider in Singapore, you just apply online.
Wow, they make it so easy there. Okay, a World Bank study reveals that only 33% of Filipino households have access to fixed broadband internet, a stark reminder of the gap in connectivity across the country. When it comes to internet connectivity in the Philippines, Joel, what are the most geographically isolated or disadvantaged areas?
The most disadvantaged areas are the ones that are furthest from the poblacion, and those are usually up in the mountains or the islands. And these are often the most difficult to connect, and the density is very low, so it doesn't often attract the big players. But for the small players,
absolutely.
the yields are good enough for us to want to come in there and connect these homes.
Yeah, and when we say fixed broadband internet, we mean people with a direct line, not relying on mobile internet.
Yes, with a direct line, that's a more reliable thing because weather tends to affect wireless. For fiber or copper going to the home, fiber needs to be cut for things to be interrupted.
Yeah, internet is akin to oxygen now. If you need it, like you need food, like you need electricity, like you need water. I mean, can you talk to us about the Konektadong Pinoy bill? What are the ins and outs of this bill? Why does it matter? And why do we need it?
So the bill is very important because the first and most important thing that it does is it actually classifies internet service. The bill that governs the internet today is Republic Act 7925, and the word internet doesn't even appear in the whole bill. It talks about voice, it talks about SMS, and we treat internet as a value-added service, a luxury. Value-added services in the 90s were the ringtones that we used to download that were popular songs. I think today, a ringtone is not as important as the mobile data on your phone. So what this bill seeks to do is to define internet service, give the NTC and the DICT the mandate to put performance standards and security standards, and to remove the franchise requirement for anyone who wants to offer internet services within the Philippines.
Okay, within the internet service provider space in the Philippines, what are our biggest challenges? Top three.
The biggest really is licensing. If I want to cover a barangay, I have to go through the same process as a guy who wants to build a cable connecting the Philippines to the United States. The licensing isn't appropriate for the various situations. Second is there's not enough competition within the ecosystem. There may be a lot of last mile players, but for the middle mile or the backbone, there are only a handful of players, and that's where the bottleneck is at the moment.
What about segmentation and competition, the playing field in the country?
So currently, there is no there is no definition of which part of the internet ecosystem someone is in. The bill seeks to classify the backbone operator, the submarine station operator, the middle mile, and the last mile, which are all governed differently. Currently, if you're an internet service provider, you're supposed to be all of those things. So that's something that's going to be difficult. And as a value-added service, there's really no regulation on quality or price. So right now, it's just the market deciding and the competition dynamics within the market deciding what service should be and what prices are.
Yeah, competition dynamics. We've got three major players now. We've got Smart, we've got Globe, and we've got Dito. Okay. When it comes to pricing, more competition, less price. Okay. The government is banking on Konektadong Pinoy, the Konektadong Pinoy bill, to reduce internet prices by as much as 50%. Now, the DICT under Secretary Aguda is promising a reduction of 30 to 50% in internet prices before the end of the Marcos administration in 2028. Do you think these figures are realistic?
I think they're absolutely realistic. We measure internet affordability two ways. It's as a percentage of income in the home. So the first thing that it's going to do, when we have more players bringing the digital jobs to the countryside, we do expect that incomes are going to grow. So as a percentage of income, we expect that the piece of the pie going down to internet being lower. And also, the big challenge for small operators like myself is the cost to get from the province to Manila is oftentimes 4 times, 5 times, 6 times the cost from Manila to the rest of the world. There are only a handful of players in that space, and if we have more, we can expect that cost to go down significantly.
Yeah. If there are more, they also need to share infrastructure in this space because that's just the best practice. How ready is the industry to collaborate?
There's a great call within the industry to collaborate. We have a lot of players coming in that need us to collaborate. It simply just won't work if we don't. The hyperscalers, they want to build here. All of the major cloud providers, they want to build here. And the amount of infrastructure that they require to invest here is a lot. And we can't bank on 3 players, we can't bank on 4 players, so we have to bank on 20 players.
The will to collaborate, that's one thing, and then at what price? And then you mentioned hyperscalers. With this bill, how much more attractive will the Philippines be for global tech giants and hyperscalers?
The Philippines is actually in a very great place. I mean, historically, the location of the Philippines has always been great for trade. We're between the Pacific and the West Philippine Sea and the rest of ASEAN. So it makes sense for them to come here. It makes sense for them to build infrastructure here, to not just serve the Philippines, but the rest of the region. However, the infrastructure here just isn't enough to serve them. We need to have more players building the infrastructure and sharing the infrastructure so that these guys can come invest and do what they need to do to help all of us move along our digital transformation.
Yeah, when it comes to best practices, international best practices for routes, the bare minimum is 6, right? 6 routes located in different places for redundancy.
Yeah, it's not just enough that you have 6 connections. You have to have 6 connections going through different places. Because for a big player, for example, a large cloud provider, if they were to be down for a minute, the costs would be in the billions of dollars.
Yeah, absolutely. If Amazon's down for seconds, imagine all the sales, the billions in sales that they lose worldwide. So right now, we can't provide the service that they need for these huge hyperscalers because we only have 3 players in the market.
Absolutely. We only have 3 players that are meant to take care of the whole market. What this bill aims to do is it aims to create the players who can serve even just the segment, middle mile, building fiber from one data center to another in a route that no one else goes to. These are very, very important and also potentially lucrative businesses that need to happen but are currently restricted by the laws that we have.
Yeah. Critics of the bill say that it's going to create an uneven playing field, new entrants, fewer rules, while existing players face heavy regulation. What are your thoughts on this, Joel?
I don't think that's entirely accurate. If you look at the bill, it's very, very clear that it empowers and mandates the DICT and the NTC to put up the standards that everybody in the internet service provider industry is meant to follow, even the incumbents. So whatever they have to follow, the new players are going to have to follow, as the law states very specifically.
There are also fears that removing franchise and regulatory controls could open us up to national security risks. What do you think about this?
That's something that really puzzles me because the people complaining about it aren't the ones who issue the franchises. So both the Senate and the House passed this bill. These are the ones who issue franchises, and they see no problem with the security measures within this bill.
So you think the guardrails in this bill are enough, sufficient?
I think so. I think it's important to give the regulators the flexibility to update, which this bill does. The security requirements of next year and 10 years from now are going to be very, very different. And if we have to change the law every time, we may not be able to move fast enough. I think this gives the regulators the agility to make sure that we are all safe.
So it's gone through the House, it's gone through the Senate. Do you think this bill is ready for the president's signature?
Absolutely. I've been following this bill for 8 years. It's gone through a lot. It's taken in a lot of feedback, and I think that the president, I think he believes its importance since he made it a LEDAC priority bill. I think he is going to sign it. I mean, he may listen to some feedback, but I do hope that the bill comes out to do what it's intended to do.
What kind of real and lasting change could we have with the Konektadong Pinoy bill? And on the flip side, what are the consequences if this bill doesn't push through?
The consequence is that things are going to be the same, right? We are one of the last remaining countries that requires a congressional franchise for participation in the data transmission industry, and we will be left behind. The AI movement and all of the other digital transformation movements, they have to happen and they are going to happen. And it's simply up to us if we're going to participate or not. The good that's going to happen is so much investment wants to happen in the countryside. They just simply can't because they don't have the way to get licensed. Someone who wants to service barangay in the mountains doesn't know what to do to get the license. He doesn't know how to go to Congress. He doesn't know all of these things. If we make it simple registration, as the bill means to do, as long as they go through the criteria that the NTC says, then anybody can put up a internet service provider in their barangay and everybody can get connected. And that's something that we want. We want everyone to experience digital transformation.
Yeah, because if we don't connect the country, then it's only the urban sectors that will really experience the digital transformation.
Yeah, absolutely.
And we need it for growth across the country.
We need it for everything. We want all of our government services to be online. We want our health to go online. We want learning to go online. We want people to start using AI. For all of these things, you need the internet. And if the internet isn't going to reach the mountain, how are the people in the mountain going to experience any of these things?
Yeah, the Philippines needs to get on board and online sooner rather than later. Thank you so much, Joel Dabao, for your time.
Thank you for having me, Maiki.
And we're taking a quick break. Business 360 will be right back. Welcome back. The Transport Department is slashing fares by 50% on LRT1 and LRT2 and MRT3 for all students, including postgrads. Starting today, students can avail of the discount on single journey tickets. Just show a valid school ID or certificate of registration. The discount applies daily, including weekends and holidays. The move comes as classes officially resume this week and follows a directive from President Marcos to make student commutes more affordable. A welcome move, but the question now is, will this stay temporary or become part of a long-term student mobility strategy? Now, global sugar prices dropped to a 4-year low, now trading at just 16 cents per pound as global supply outlook improves and demand softens. The U.S. Department of Agriculture projects a 4.7% jump in world sugar output for 2025 to 2026, led by stronger harvests in India, Thailand, and Brazil. Favorable weather and Brazil's shift toward corn-based ethanol have freed up more cane for sugar production, pushing prices down. Weaker demand from China and slower imports from Indonesia and Bangladesh are adding more downward pressure. Experts say this price drop could mark a turning point after years of supply disruption from La Niña. For traders, retailers, and food manufacturers, the shift could ease input costs but also signal tougher export conditions ahead for producers in the region. The 20th Congress has yet to open, but the race for Senate President is already underway. Senate President Cheese Escudero and Senator-elect Tito Soto are now courting allies ahead of the new session. Senator-elect Erwin Tulfo confirms both camps have reached out, hoping to secure his support for the top Senate post. But Tulfo says he's holding off and will first consult his brother, Senator Raffy Tulfo, before making any decision. He adds he's approaching this politically sensitive moment like a journalist, hearing both sides before taking one. Tulfo says he's already studying up for another key role, senator judge in the impeachment trial of Vice President Sara Duterte.
Si Senator Cheese at saka si Senator Tito Soto. Pero ngayon, tumigil na eh. Baka may napili na sila.
Did you give your support to who?
Wala eh. Nagbakasyon ako eh. Hindi pa ako binabalikan. Mamaya mag-uusap kami ni Sen. Raffy. Susundan ko lang siya kung sinong gusto niya. Kung gusto niya si Tito Soto, disobey. Kung gusto niya si Senator Cheese.
And while power plays unfold in the Senate at Malacanang, President Marcos is taking aim at a long-standing education issue. The president now admits the K-12 curriculum has failed to prepare students for employment, a view shared by lawmakers in Congress. In an interview with the Bilyonaryo news channel's Agenda, House Basic Education Chair Roman Romulo said that the system was poorly planned, overloaded with subjects, and left many students functionally illiterate.
Talagang palpak po talaga. And it's because masyado pong congested, hindi pinag-isipan ng mabuti yung curriculum. Kaya it's high time to reform the K-12.
Romulo adds that a bill to reform the curriculum has already passed final reading in the House with a goal of making senior high graduates more job ready. From classroom challenges to commuter safety, the Transportation Department has ordered the temporary suspension of toll collection at the NLEX Marilao northbound segment. The move follows a deadly truck accident and puts the spotlight on enforcement, infrastructure safety, and business disruption. The latest incident at the Marilao Interchange Bridge left one person dead, prompting officials to suspend toll collection until all lanes are cleared and safe to use. The disruption is expected to affect commuters, haulers, and time-sensitive supply chains in and out of Metro Manila. NLEX Corporation says it is cooperating with authorities and will assist the victim's family. It points to non-compliance with height restrictions as a key factor and calls for stricter enforcement of traffic rules, saying safety is a shared responsibility. We're taking a quick break. Business 360 will be right back. For staying silent on Israel's strikes. Iran's atomic energy chief Mohammad Eslami accuses International Atomic Energy Agency, or IAEA, Director General Rafael Grossi of failing to act after Israel targeted the Arak nuclear facility in a fresh round of airstrikes. But Grossi says the agency is monitoring the situation closely and that the IAEA inspectors remain on the ground ready to access sites when safe. He also says he's willing to fly to Tehran, signaling diplomacy isn't off the table. All this comes as fears grow that the Israel-Iran conflict could expand, dragging in global powers and rattling energy markets worldwide. Now, recruitment agencies are being warned not to deploy Filipino workers to Israel, Jordan, or Lebanon as violence escalates across the Middle East. Department of Migrant Workers Chief Hans Kakdak says agencies that violate this will face sanctions and will be required to cover the repatriation costs of any workers they send. Kakdak notes that while deployment to Israel and Jordan is still technically allowed, ongoing airspace restrictions make travel to those countries nearly impossible. 58 overseas Filipino workers remain stranded in transit hubs in the UAE as the region remains on edge amid rising conflict. Russia, home to the world's worst nuclear disaster in Chernobyl, is now warning Israel. A strike on Iran's nuclear power plants could trigger a catastrophe worse than any accident in history. The head of Russia's nuclear energy agency says an attack on Iran's civilian nuclear facilities could surpass Chernobyl, the 1986 disaster that released radioactive fallout across Europe, displaced hundreds of thousands, and left a lasting environmental scar. Iran's only operating nuclear power plant in Bushehr was built by Russia. On Thursday, Israel claimed to have struck that area, but later called it a mistake and said it could neither confirm nor deny if the power plant was hit. The warning raises new concerns not just about escalation, but about what happens if nuclear infrastructure is caught in the crossfire. On another front, global investment fell for a third straight year in 2024, and the United Nations warns 2025 could be even worse. The UN Trade Agency says geopolitical tensions, rising tariffs, and deepening trade fragmentation are eroding investor confidence and stalling productive investment across these sectors.
If that is the picture of 2024, we are even more worried about the picture in 2025, because we know that uncertainty is really poison for investment. And we already feel very clearly that investment is halted. That, as one CEO said, sit and wait is what is taking place, and so investment is being postponed, and we fear that the outlook that we will see at the end of 2025 is not going to be better.
Europe saw the biggest hit with investment diving 58%, but North America and Southeast Asia bucked that trend, with ASEAN attracting a record $225 billion. Still, the UN warns that critical sectors like infrastructure and energy are being left behind, jeopardizing future growth, innovation, and jobs. Elsewhere in the world, Greenland grants a 30-year mining permit to an EU-backed project to extract molybdenum, a critical metal used in defense, energy, and aerospace. The Malberge mine, run by Toronto-listed Greenland Resources, could supply up to 25% of Europe's molybdenum needs as China tightens export controls on strategic metals. The project marks a major step for Greenland's mining sector, which has gained global attention since U.S. President Donald Trump renewed interest in purchasing the territory earlier this year. With China producing 40% of global supply last year, European and U.S. officials see Greenland's new role as key to reducing dependence on Beijing. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo news channel, and have a good weekend.